In the late 1960s and beyond, we have experienced crises fueled by concept stocks, ones whose current valuation appears out of line with traditional valuation metrics. Mutual funds proliferated. Furthermore, the fund holdings tended to be stocks that possessed an exciting concept and generated great near-term performance. As many of these funds soured in the 70s, investment wisdom returned to sound principle. Solid blue-chip stocks came into vogue as investor expectation turned toward long-term benefits.
The enticement of one-time decision for large caps, large capitalization stocks, attracted conservative institutional investors who had strict fiduciary duties for the management of the savings of others. Unfortunately, well-packaged stupidity sounded like wisdom as a wave of institutional speculation occurred that focused on blue chips.
Nevertheless, these actions seemed reasonable at a time in which inflation was under control, the Vietnam War was ending, and Richard Nixon had been elected president. Investors ponder what is OPEC and who are these new upstart competitors posing a threat to American manufacturing. The Nifty 50, the largest of the S&P 500, had begun to decline, even though their share prices held steady due to the madness of crowds.
Soon, investors realized that stocks were overpriced and that it was the market, not the companies, that constituted the problem. Subsequently, fund managers began to sell their holdings in the 4 dozen or so blue chip companies.